Hello, welcome to this video, and in this video we're going to discuss about how to build three statement model using Excel. Well, when we're talking about the three statement model, it includes profit and loss, balance sheet, and statement of cash flows. So the three statement model is mainly used when you are raising some kind of money for your business or you're planning to expand your business. So it will help you to raise some money, or if you want to plan your forecasting, and that's how it is used. So in this example we're going to use that we are assuming that we are selling chocolates, and we are going to take some assumptions. So for the assumptions, we would expect to be in the blue font, and they should be bold. Okay, so we are expecting to sell around 5,000 units in year one, 6,000 in year two, 6,000 in year 3, 7,000 in year 4, and 8,000 in year 5. So we are expecting to selling price per unit will be like $40, and it will remain same for the next year. The purchasing cost, we are assuming that it would be like $15, and it will be remaining same for the next 5 years. So these things will help us to calculate the profit or loss for the year. And then we have to calculate the working capital for our business, which includes the receivable days, payable days, and inventory days. So receivable days, we are expecting to have like 40 days, and it will remain same for the next 5 years. Let's say payable days is like 30 days. We are paying our suppliers in 30 days. Inventory days is 20. Okay, so we will use these to calculate receivable, payable, and inventory. So we also purchase some kind of machinery, so it would have some kind of cost. So we're gonna add that cost right there. So let's say we purchase a machinery for $4,000. It will be also in blue because it's an hard-coded number and it's an assumption for our financial model. And then depreciation assumptions. So obviously we purchase a machinery, then we have to depreciate the machinery. So we take some assumption regarding depreciation. Let's say we're gonna depreciate the machinery by 5% on a straight line basis. The depreciation will remain the same for over the 5 years. Okay, so let's start making some schedules. So how the sales will be calculated for the year one? The year one sales will be calculated using the formula of number of units multiplied by selling price. So number of sales units is 5,000, multiplied by the selling price is $40. So we're gonna just multiply that, and we will copy paste this for the next 5 years. And then we got the sales for our profit and loss. Okay, again we have to add a dollar sign if there is a currency there. And so we go to there and click on currency, and there we go. So we have a dollar sign right there. So if there also we have to add a dollar sign right here, what we can do is we can click over there and click on format painter, and then paste this here, and you can see that the plant and machinery cost is also in a dollar format. So these all should be a dollar format. So I will select all of these and click on currency, and then this. So there's a little bit formatting there. So then what we have to calculate is cost of goods sold. Then how are we going to calculate it? The formula would be sales units multiplied by purchasing cost per unit, which is $15 right there. The cost of goods would be 75,000. We'll copy that and paste over the 5 years. And then what's next? We have to calculate some kind of, okay, let's add some more assumption regarding more expenses for our business. So let's not add there. Let's add here. So let's say we have a rental expense. Let's say we have a office expense. travel expenses for our business. So we have these kind of three more expenses. So we will assume all of these expenses will remain the same. Let's say it will be 400, it will be 300, it will be 700, and it will remain the same over the 5 years. Okay, so these are our more expenses which we assume at this case. Okay, after the cost of goods sold, what we have to calculate is our inventory, receivables, and payables. Inventory, receivables, payables. Okay, so how do we calculate the inventory? We will use cost of goods sold to calculate our inventory. Okay, so we will 75,000 multiply by inventory days. How many inventory days are there? It's there. It's like 20 days divided by 365. So that's how we're going to calculate our inventory. So we'll copy that and paste it over that period of time. So we got our inventory. For the receivables, we will use sales. So what is the sales for this year? It's like $200,000 multiplied by what is the number of days of receivables? It's 40 days divided by 365. And there we go. We'll copy that and paste it over that period of 5 years. And for the payables, we will use payable days and cost of goods sold to calculate the payable days. This multiply by payable days divided by 365. So we got our payable days, receivable days, and inventory days. And now what we have to calculate here is depreciation. So instead of depreciation, we'll create a small section there for the calculation of the net book value of our non-current assets also. So let's add cost, depreciation, accumulated depreciation, and then net book value. So these three figures we will be using. So the cost will remain the same over the 5 years because it's the historical cost. So we will add a reference there and add a dollar sign. So if we copy paste this cell, so it won't change the reference. Okay, if we copy paste and we got the same $4,000. And how to calculate a depreciation? It's simple. Select the cost, multiply it by our depreciation assumption, which is 5%, which will remain fixed. So that's why we are adding dollar signs right there. If you go head over to the formula bar and see it, copy, paste. And then how the accumulated depreciation will be calculated is equal to, for the first year, it will remain the same because the depreciation will not be added up any kind of a prior year. So that's why it will remain the same. For the next year, it will be sum is equal to selecting both of these and then adding a dollar sign in the first cell. So if you copy paste that, the first reference would not be changed. So it will be copying and pasting this. So we got our depreciation, accumulated depreciation, and to calculate the net book value for the asset, we'll just deduct the cost minus accumulated depreciation to get over that net book value. Copy paste till the end. So that's how we're going to calculate the net book value. Let's do a little bit of formatting right there. So there we go. We calculate the net book value of our assets. We calculate the receivables, payables, inventory. So we have a little bit done now. In the next stage, we will calculate our profit and loss, balance sheet, and then cash flows. So let's head over to the profit and loss and see what we got there. So we'll just copy paste the years right there and start with sales. So sales would be already been calculated. We just have to reference it from the above. This is our sales and we will copy, paste it And then what we got is cost of sales. We can also add this as a COS or cost of goods sold. So it we will reference it with this. This is our cost of goods sold and copy paste. Then we got our gross profit. Our gross profit will be sales minus cost of goods sold. This is our gross profit. We will copy that and paste it over there. Obviously, it will be in bold and we will gonna add a line above there so it would do a little bit formatting. And we have to add other expenses. So what are the other expenses right there above? We have added some kind of rental expenses, office expenses, travel expenses. So we just added all the expenses which are other than that, and also depreciation expense. I forgot about that. Depreciation expense will be part of our profit and loss. So rental expense will be this $400 per year. We will copy that and we'll paste it till the year end for the 5 years, and then the office expenses is equal to what is the office expense? It's $300, and mention that and copy and paste till the 5 years. What about the travel expenses? It will be $700. We will just add as equal to and mention that cell and copy and paste. So the only expense which is left is appreciation, which we already calculated. So it will be like $200 for each year. So we will add that. So we have total other expenses. So we have to add all the expenses. Just click over there and total expenses. This is our total expenses. We're gonna sum and add all of these expenses. Copy, paste. So let's add another line above, and we got our net profit just below that. So how do we calculate net profit? Gross profit minus total other expenses will be equal to the net profit. 125 minus 1600 will be the part of the net profit. There we go. So that's how we're going to calculate our profit and loss for the three statement model. And let's a little bit of formatting. So let's head over to the balance sheet. So first, before we start balance sheet, what we have to calculate is our retained earnings. Okay, so we're gonna add more schedule for our retained earning under the schedules right there. So to calculate the retained earnings, we just have to add two things: opening balance, oh sorry, three things: net profit for this year, and then closing balance. These are the three things that we have to add right there. Obviously, the opening balance for the year one will be zero. So it's a hard coded number, so we'll add it in the blue. The net profit for this year is 123,400. And what will be the closing balance? The closing balance will be opening balance plus profit for this year. This is our closing balance. And this year closing balance will be the part of the next year opening balance, which is the same, obviously. And this year profit will be is equal to this. The profit is already there, and we will just copy pasting the formulas which we just calculated. And there we go. We are ready. Our closing balance of the retained earnings is already there. So how what is this? This is retained earnings, which will be the part of the statement of balance sheet or statement of financial position in this case. So that's how we're gonna calculate our retained earnings right here. Inputs, schedules, profit and loss. Let's go to the balance sheet. So we're gonna click on equal to and mention the years. Add some headings. Add a heading for assets, liabilities, and equity. So under the assets tab, we have two sets: non-current assets, non-current assets, current assets. In the liabilities tab, we have non-current liabilities. Well, in this case, we don't have any non-current liabilities, so we will gonna just add nothing there. So under the equity, we will add, if we some add some kind of equity in the business, so we will add a capital section right here, and then we will add retained earnings. So these two things will be the part of here. And just add some spacing right there, so it will be shown that it's under some head. Under the non-current assets, we have two things, only one thing: plant and machinery. Plant and machinery. Under the current asset, we have three things: cash, receivables, and inventory. So all of these will add up to the total current assets. If we add all of these things, we got total assets. Total assets. Okay, so let's do a little bit of formatting right there. Okay, we have to add some spacing right there. The total assets will be this. So let's add a line there. So the total plant and machinery balance will be the part of the net book value which we just calculated above, which is this 3800, and copy and paste to the 5 years. What about the cash? We have to calculate the cash using the statement of cash flows. And receivables is already calculated under the schedules tab, which is this. Just mention the receivables and copy paste. What about the inventory? Inventory is also there, which is this for 110, and then paste. To calculate the total asset, we just have to add the sum for all of these things. Enter, copy, paste, and that is the sum for total assets right there. And then the liabilities. What will the part of the liabilities? Just payables. So we just add the payables right there and add a little bit of formatting and just mention all the payables which we have currently, which is this for the next 5 years. This is our payables. What will be the total liabilities? The total liabilities will be just payables. So we just mention this and then boom, just add a format right there. That's we go. That's how we're going to calculate total liabilities. What about the capital? Do we invest something in our business? Yes, we have invested one thing, which is plant and machinery. The plant and machine will be the part of our capital. So what we can do is we can just mention here, if we have invested more than one thing, then we can create a separate schedules in this case. So the under the equity section right there, rental expense, office expense, travel expense, payables. This is the investment which we have did for our business. We're gonna add right there, which is remaining the same for over the 5 years. What about the retained earnings? Retained earnings is calculated above as a closing balance. Okay, so we will copy paste this. So our total equity will be adding up these two things, just this, and then we will copy paste till the 5 years. So that's how we're gonna add the total equity, and then we have to calculate a balance check. So our balance sheet balance check, which is assets is equal to liabilities plus capital. So total equity plus total liabilities minus total assets, which will not balance because in the current case we don't have any kind of cash balance. So in order to calculate the cash balance, we are using currently statement of cash flows. So let's create a statement of cash flows right there from the year 1 to year 5. Copy paste for the year 5. So we will start with, there are mainly three things in statement of cash flows. So it will be starting with operating activities, financing activities, and investing activities. So how much money we will be making over using our operation, using our financing, and investing. And then using all of these, we will calculate three things: opening balance of cash, change in cash balance, and then closing balance of cash. The closing balance of cash will be the part of statement of financial position. Okay, so closing balance will be calculated using the sum of these two till the 5 years. Okay, so we will add this over there and mention under the cash section. Under the cash section, we will mention this closing balance of cash. So it will be there when we add things up. Okay, so investing activities, operating activities, and change in cash balance will be calculated. So so there is obviously a total in each and everything. So the total for investing activities, total of financing activities, and total of operating activities. Okay, perfect. So in the operating activities, we will start with our net profit and then add back depreciation. And then we will add the change in working capital. Change in working capital. So which includes receivables, payables, and inventory. And then we got the total change. So at this stage, we have our net profit, our depreciation. So let's head over to the profit and loss to find the net profit for the year, which is this. And we also have depreciation. We will add back that. Where is the depreciation? This is our depreciation. So that's how we're gonna add the depreciation and receivables. Well, receivables will be a decrease in cash because we are expecting to receive money in the future. So that's why it will be added as a minus right there, and it will be the same for the inventory because we are purchasing the inventory, so our cash is decreasing. So in the statement of cash flows, we are seeing each and everything based on our cash. Okay, how do we calculate for the year two? So year two, if there is an increase, then it means that our cash balance is decreasing. So we will use year 1 minus year 2, and we will copy paste that for the next 5 years. And it will, I think I just did a mistake. Instead of inventory, I just use payables. And for the inventory, what we do, we will do the same thing. Year 1 minus year 2. Boom. There we go. For the payables, we will just add the payables, because if it's increasing, then it's a positive in cash because we are delaying the payment to our suppliers. So year 2 minus year 1 for the payables, copy paste, and then we got our total operating activities. If we sum all of these, we got our operating activities, our financing activities. If we just raise any kind of finance, and in this case we don't raise any kind of finance because we have a zero cash balance, but our equity part has $4,000 in capital, which means that we have raised some kind of finance. We can say we have raised $4,000 for equity, so we will add a $4,000 in year 1. That's it, which will not be there in the year 2, year 3, year 4, because it will be the part of the equity. We'll just mention and link it with the equity right there. And what about the investing activities? So the total will be this under the financing activity, which is zero in the next case. What about the investing activities total? So we have invested in property, plant, and equipment. Property, plant in year 1. So we have plant and machinery investment for the year 1, which is this. We will select this and add a minus sign. So the total will be this. Okay, we have to just go there and add a full point. So what is the change in opening cash balance will be 0. So it's a hard coded number. It will not change. And a change in cash balance will be the part of this, this, and this. I will do a little bit of formatting after it. So I want to make sure that the balance in the balance sheet should be same. So adding a net profit there. So in the year 1 we have balance sheet, but over the years we don't have really balanced our balance sheet because we don't just copy pasted the opening balance right there. So if we just copy paste the opening balance, we got our balance sheet balance, as you can see on the balance check. So you can do a little bit of formatting, bold this and add a line there, bold this, add a line there. So that's how you can calculate statement of cash flows, statement of financial position, statement of profit and loss using financial modeling using Excel. And if you need any kind of services regarding financial modeling, bookkeeping, or taxation service in United States or United Kingdom, you can head over to the about of my section to you can reach me out and you can ask as many questions as you like. So see you in the next video.